Welcome to the Capital Connect podcast. My name is Ben. I'm the co-founder and CEO of Monark. On Capital Connect, we take a deep dive into the most interesting and timely topics in private capital markets with the most informed and intelligent guests in the ecosystem. Today, I'm joined by Yann Magnan, the co-founder and CEO of 73 Strings. 73 Strings is an AI-powered platform for data collection, portfolio monitoring, and valuation that powers the private capital industry, helping alternative investment funds streamline the middle office processes that have historically been defined by spreadsheets and manual work. The platform supports clients globally across private equity, growth equity, venture capital, and private credit, and is trusted by some of the world's largest asset managers. Yann brings more than 25 years in valuation and corporate finance experience, including building the Paris office of Duff Phelps and serving as its EMEA market leader. 73 Strings is backed by Blackstone, Fidelity, International Strategic Ventures, and Broadhaven Ventures. Well, Yann, thank you so much for being here. I really appreciate it.
Thank you, Ben.
It's good to see you. Yep. Maybe let's start with the founding moment for 73 Strings. What was that like? What problems did you see, and what really prompted you to start the company?
Yeah, that's a very good question. So actually, it's an interesting story. I think it's interesting. It's definitely interesting to me. As you can see, I'm not the typical young founder of a startup. I've had a 25 years career in the financial advisory industry, and more specifically doing valuation for alternative assets and non-listed assets. And with that as a background, 25 years, and I have also a background as I studied engineering, but I went straight into accounting and finance after studying. After 25 years of doing that, so that was getting us towards 2020. So now you have an idea of what age I am. But towards 2020, I started to think that, realizing that everything that I was doing in terms of valuation of non-listed assets, everything was manual as in Excel, Google search, and email. Everything that my teams were doing, even worse, was manual as well, as in a lot of inefficiencies, a lot of risk as well, as in fat fingers. And everything that my clients were doing was percent, Excel, Google search, and email. And I started thinking, and there must be ways to do things like differently. We could be using technology to create, a platform that could create more structure to the process. And on top of that, we should be able to use AI as well to again create efficiencies, do certain tasks that I was asking my teams to do them like more, automate them. And that's basically the founding moment for us for 73 Strings. So realizing that technology was mature enough that you could develop a platform at a reasonable cost for clients, help solve what I was thinking was their pain point, was like totally disjointed valuation process.
I'm sure the rate of acceleration now has been exciting, but I'm curious maybe to go back from 1995 to 2020.
Yeah.
How would you describe the change in the processes that the industry followed in terms of data collection and valuation, if there was much change at all in that 25-year span?
There's been massive changes, and getting back to 1995, it's definitely a jump back. Thing that, look, when I started working at EY in that particular instance, we were sharing laptops, like one analyst had 3 laptops. And most of the work we are doing was actually writing down on a piece of paper, which, as you can imagine, when it comes to valuation and you have calculations to do like DCF and this type of thing, that was really like a nightmare. I mean, of course, that evolved like really, really fast. But the key thing was, everything was, you take data, try to structure that data manually, try to understand what are the nuances between EBITDA for this company, EBITDA for that company, put everything at the same level, standardize everything, get that into a model, run the model, and then run it again with different assumptions. And all of that was, as I said, manual. So lots of time spent just getting data into a system, into an Excel model, with all the issues that goes with it, like basically, again, fat fingers, missing something somewhere. You have an intern, no disrespect to interns, but that's something hard-coded formula where he or she was not supposed to do that, and you can't uncover it. That happens to anybody. But the issue is, how do you uncover that type of situation? So that's basically the world we lived in. And then we've seen two things happening in parallel. Number one, technology becoming more and more mature. And of course, cloud has changed everything. And number two, what we've seen as well is the massive influx of capital towards private capital, which has led alternative investment funds to grow pretty fast, to invest more into portfolio companies, and to be looking as well for more structure in the way they do things to be able to report to LPs better and faster. So those two trends were basically happening more or less at the same time and converging towards 2015, 2020. And more recently, what we have seen happen in the past 2 years, I mean, it's the trend that I'm going to talk about is older than that, but it's really started to pick up in the past 2 years, is the trends towards alternative investment funds trying to raise capital from retail investors, evergreen type of structure. More recently in the US, we are talking about 401k plans that might be able to invest into alternative assets. So all of that is coming to an inflection point where things are going much faster.
We'll definitely touch on evergreen funds, but first, maybe just to speak to the power of the 73 Strings platform today. So you really set out to try to automate both the data collection, but then the ongoing valuation of portfolio companies specifically for alternative asset managers and private investment funds, which obviously has benefits for portfolio construction and reporting for LPs. I guess I'm curious, one, maybe just talk to what the platform does today, how you're using AI in managing the data across alternative investment fund. And specifically, I'm curious how you think about how portfolio managers should really separate between what the platform should do versus what they should be doing, and how much they can automate with a platform like 73 Strings.
Yeah, that's a very good question. So maybe let me start with a statement. So I've always been saying, even when I was a corporate finance valuation consultant, I've always been saying to my clients at the point in time, valuation is art and science. And I still believe, I'm still saying the same, that valuation is art and science. What does that mean? Art and science, that means that there's two components into a valuation process. Number one, everything that's calculation, the valuation models, the discounted cash flow multiples, a waterfall on a cap table, OPM, CVM, all these type of calculations. That's the science piece. The other part of the science piece is, in particular, when it comes to the alternative investment fund, that has to do the valuation of the same assets over and over again for reporting purposes, is the workflow. So how do you get from A, I'm receiving data from my portfolio company, the borrower, to Z, I'm reporting that valuation to my LPs, to fund the funds, and so on. So that's the science piece. The art piece is actually everything that's human judgment. As of today, there's always, in each and every valuation, there is a need for someone to pick a number, to pick a judgment. Like, basic example, a private equity-backed company, typically valued based on a multiple of EBITDA. You have a peer sample, a sample of comparable companies. You get to a range of multiple, 12 to 14, whatever, and someone has to pick a number in there. Could be 13, the average could be 12.5, could be 14, whatever makes sense based on how the business you want to value really compares to that group of comparable companies that you have. That's what I call human judgment. What we are doing at 73 Strings and what I think technology should cater to is everything that's the science piece. What we are not doing, we don't even want to touch that. I don't think that it's a good idea to get technology touch that, is the art piece for a couple of reasons. Number one, it's very complex. Number two, clients want to be able to exercise the judgment that they think is relevant. Number three, because the valuation we're talking about is post-investment for reporting purposes, you want someone to be accountable for that valuation. So basically what I'm saying is that when it comes to technology, even when it comes to AI, we are applying technology and AI to processes that are deterministic to enhance these processes without trying to replace the deterministic side of things. So like, for example, the first area where we have applied AI in 73 Strings is for data collection. So basically reading any type of document, PDF, PowerPoint, Excel, email, compliance certificate, a board deck, whatever you can think of, read, identify relevant pages, relevant KPIs, collect these KPIs, structure these KPIs, standardize these KPIs. That you can do that with AI really, really well. Where we don't apply AI is where, for example, is where there is human judgment. Is that doable? Yes. Certainly, it's doable. But the issue is that if you get an AI algorithm to spit out what should be a human judgment, the issue is that you can't really understand that human judgment. It's a bit of a black box behind. and who are you going to sue if something is wrong?
Sure. That makes sense. And so as you're building out 73 strings, your clients, you're selling into sort of the managers, right? The venture funds, the private equity funds, the credit funds. And they have the challenge that you touched on, which is they have to collect data from their portfolio company. Yes, right? So what are you guys doing on that front in terms of the actual data collection? What is sort of the adoption that you're seeing from portfolio companies to actually report their data into the fund managers?
Yeah, so we have developed a set of technology that basically helps read any type of document, as I explained previously. Yeah, the documents, we are leaving the choice to the GP to decide how they want to collect these documents from their portfolio companies. So it can be through any type of box sharing type of process, could be through email, could be through other type of technology solutions like you guys collect the documents. What we are doing is reading these documents and extracting the relevant KPIs. We are not doing just that. We're collecting these KPIs, but we're also keeping a full lineage and audit trail from the numbers and KPIs that we collect to the original source document, because these original source documents are the source of truth for our clients, and our clients have fiduciary duties. We need to be able to prove that everything that they have done or every number that they have used in their process is sourceable. So we are keeping that full audit trail to the source document, which means that we also become the source of truth on our side once we have that.
And is the data that's getting sort of fed into the system generally self-reported from the portfolio companies?
Yeah, most often. So yes, so the data is self-reported depending on the strategy that our clients is focusing on. The investment team might have a view whether these KPIs that are reported should be adjusted. If a reported EBITDA should be adjusted for whatever type of pro forma adjustment like acquisitions or these type of things. So it's a combination of the documents, the information that flows from the portfolio company, and then some level of judgment that comes from the investment teams on top of that. Definitely very, very much so for private equity, maybe a bit less for private credit. Depends on strategy.
Sure, that makes sense. You mentioned evergreen funds. So obviously all of this activity in the industry is occurring against the backdrop of more retail exposure to private markets and more demand from advisors and individual investor clients to get access to evergreen funds in particular, but also some drawdown strategies as well. How has that shift impacted the role of the GP in portfolio management, reporting, and data collection? How is that impacting 73 Strings as a business?
That's another very, very good question. So if I take a step back, before Evergreen, valuation was a reporting exercise. I'm a GP. I have received capital from various LPs. They need a reporting every quarter. I'm going to provide them a report. There might be sometimes, from time to time, secondary transactions happening on these holdings, but basically the number they have to report is a number that goes into the LP financial statement, and they have their own regulatory requirements, so they have to report fair value. So it's very important, don't get me wrong, but it's a reporting exercise. What's happening with evergreen type of strategies, retail investors coming into the mix, and probably even more so tomorrow with 401k plans, is that actually these investors are transacting now on this valuation. So valuation is not just a reporting exercise, it's not just a number, it becomes transaction grade. That's by far the most important transition that's happened. The second transition that has happened is that the world was basically mostly quarterly reporting, again, for the purpose of financial statements. Now, if you want to get retail investors to invest into your fund and you're a GP, you typically have to offer these investors to be able to enter at any point in time, to exit mostly at any point in time, which means that you have to offer a higher frequency in terms of reporting, a higher frequency of the evaluation process as well. So that's the second impact that we've seen happen in the past 2 years.
You mentioned reporting to LPs was historically on a quarterly basis, with evergreen funds becoming more real time. Apollo as a firm has been public and very vocal about moving their evergreen fund valuations to daily NAVs. It seems like that is the direction to travel for the industry, but in your opinion, how long do you think it takes for alternative investments as a whole to move to daily pricing for evergreen funds?
Also, we already have clients that are doing daily pricing of their alternative assets. I think it's going to move pretty fast, especially on the back of the 401k plan potential evolution. 401k plans will require daily valuation, same as mutual funds will require daily valuation. So a significant chunk of the market is going to move in that direction. And 401k alternatives into 401k plans might take a bit of time to get up to speed. There will be some hesitancy, I think. But the other thing is that if you are a manager, if you are a GP, and you expect to raise only 20 million from 401k plans in the next year, anyway, you have to be able to run daily valuations across your portfolio. So that is going to happen pretty fast. So that's a trend that's going to happen. I think that's not the only trend that is going to happen as well. Clearly, as we go down that path, what that means, I think, that's my personal view, is that private capital is definitely meant to be private. But I think it will become less and less private in the sense that there will be a need as well for more transparency in terms of not just the valuation, but the underlying data. That's the only way that you can create the trust that will really drive significant capital influx into that part of the industry.
Yeah, strongly agree with that. I think as more transparency comes into evergreen funds in particular, and more retail investors come into these products, you will see increasing demand. You're seeing it already for more liquidity in these products, and it's very hard to have liquidity without a price. So certainly makes a lot of sense there. If people are interested in learning more about 73 Strings, where can they find you? How can they reach out?
Just reach out to me on LinkedIn. That's the best way to reach out to me. I might be anywhere in the world, but I would answer in less than 8 hours, maximum 8 hours.
Amazing. Well, Yann, thank you so much for being here. This was a pleasure and great.
Thank you for listening. Thank you, Ben.
Absolutely.